So listen, Fib is something that is it's used by a lot. Some are casual users, some are a little bit more advanced, and it depends on where you are. If you haven't quite incorporated it into your trading plan, I would say you're probably a little cautious or a little hesitant. And let me ask you. You can put it in the chat window or just answer the question to yourself. What are the couple reasons that you don't use Fib? One, you probably think it's voodoo and hocus pocus, right? How about this? How about this one? You don't know where to start and stop Fib analysis, or I just simply call ratio analysis. And then the other one that I hear a lot is people say, well, all right, you have a bunch of ratios. Which one is going to work? Like, which one works? So if you have any of those questions, all very, very valid, and I'm going to dive in and show you exactly how to answer those questions. Generally, I find that about 61.8% of the people believe in Fib, and about 38.2% don't believe in Fib. I'll let you think about that one for a second. All right. So a little warning. We got to do the warning, and I'm kind of a glass half full kind of guy, so I always try to look at the government warnings and say, what's kind of good information in here. There's obviously substantial risk of loss, which I agree. Only risk capital should be used to trade, which I agree. It's definitely not suitable for everyone. Okay, there is significant risk, and you must be willing to accept these risks before you put into a trade. Don't trade with money you can't afford to lose. I mean, these are all pretty valid points, except they're coming from the government, which is fine. But, one thing I would disagree with, I was listening to Mohan there, and I disagree with what he's saying. You need to be rich or well capitalized to trade. I disagree. I don't think so. I think you could trade with, I don't know, $5,000, $10,000 account. You're not going to be looking to make $15,000, $20,000 at the end of the year, but in today's markets, today's options markets, you can very safely buy a vertical spread. It costs you a couple $100 in margin. I disagree. I think you can trade comfortably with a $5,000 or $10,000 account as long as you were prepared for what your expectations are managed, right? So let's. I disagree. I think anybody can trade as long as you can stick to a discipline, stick to a process. So let's talk about busting some myths. All right, technicals don't work in highly emotional markets. Before we dive in, anybody heard that? Believe that? Don't believe in that? What do you think? I'm going to see some answers in there. I've definitely heard people say it before, and let's take a look at this one. How about the 1925 to 1929 rally in the Dow? Okay, we had the roaring 20s. Things were going well in the U.S., and all of a sudden, you guys know what comes next. Crash. The economy's falling apart. Businesses are collapsing. People are losing their entire savings. People are unfortunately losing their lives. It was just a catastrophic event. The United States has never seen anything like that before. But look what we've done. We sold down from a Dow of 386 down to a Dow of 219. And if you look at the distance we traveled from 115 up to 386, the level that held us several times was 219 in the Dow, and that winds up being a 61% retracement from the entire move. Okay, so this is the key Fib level. This is where all the ratios are built around. And if you think about it, back in 1929, technical analysis wasn't as prolific as it is today. It wasn't as well known as it is today. I don't think people were watching the 61% retracement while the Dow Jones was crashing in 1929. In fact, I think it's probably the furthest thing from most everybody's mind. I'm pretty sure that shorts, if there were shorts, didn't cover because we're at the 618 retracement. And I'm pretty sure the 618 retracement was not the reason that we just dropped away after a long test. There is something to the ratio, all right? It is reflective of investor psychology on a mass scale. Okay, I can tell you nobody's watching the 618 back then. All right, so just a little bit about me before we dive in. I'm Todd Gordon, and I've done. I've had a great career. I'm not, that far along here. I've been in this business. I'm 36. I've only done this half my life, and I've had the good fortune of working with some very awesome people and pretty talented people. And you know, I'm a big believer that to advance yourself in whatever profession you've chosen, you've got to surround yourself with people who are more talented and skilled than you are. So I've always tried to surround myself with people who are basically cooler than I am, and it served me well. And that is Donald Trump at my wedding. That's Damon. Anybody watch Shark Tank? I was on TV with Damon, and then this is my personal favorite. How about Cliff from Cheers? You guys remember Cliff? You guys ever see the Jeopardy episode on Cheers? And there's Trump again. So again, I've been very fortunate in this business, and I do live here in New Jersey with my wife Trish and our two sons Jake and Brody. They're a year old, and in fact we're all going to Florida. We have a house in Fort Lauderdale, and we're going down for the first trip on an airplane. God help me. I don't know how this is going to go, but I'm bringing my trading computers down, and I'm going to work for a week. And while the kids and family go to the beach, Dad's going to be working and trading. And as I said, I've done some stuff on CNBC over the last 4 or 5 years. I've been on about 250 times. Some been good, some been bad. I've got you know, one story here that's I don't know if you guys will be able to hear this audio, but this was live on I think this was Street Signs, and I actually dropped my microphone live on air, and Mandy Drury and Brian Sullivan are laughing at me. And that's not even the worst thing I've done on TV. This was the doozy. So one time I was on Fast Money, and it was commercial break. This is Fast Money here, and they said, Todd, come up with a quick biotech stock that looks good on the chart. So I was all right. So I typed out DNA, Genentech. You guys remember that? I looked at the chart, and let's say it was like March 2008, and then I said, all right, chart looks pretty good. And I said, all right, so I got on there, I said, Genentech looks good, DNA, chart breaking out, and then 5 minutes later, a producer gets in my ear, and they say, Todd, that stock stopped trading about a year ago. It's delisted. And I said, oh, good God. And I looked at the chart. It was that month, but it was exactly a year ago, and I didn't notice the year in the chart. So I thought I was going to get fired, but I didn't. They kept me on. So we actually have a new show coming out tomorrow. They've been working on it for 3 months. This is some of the filming. It's called Trading Nation, and it's actually geared towards at-home traders like you and I. So keep an eye out on it. You know, it's CNBC certainly has a lot of fundamental stuff and stuff like that, but they're definitely trying to work towards at-home traders. So I think you guys might enjoy it. All right, welcome, Zoltan, Jersey. There you go. There you go. Left 30 years ago. All right. So do you trade with any of these presumptions? We talked about this. Technicals don't work when markets are highly emotional. Technicals are self-fulfilling prophecies. And I only trade when my indicator issues a clear buy-sell signal. I'm going to tell you that trading is more than just buy-sell signals. There's more to it. It's a skill game. It can be learned, but there is skill that's involved. All right. So let's get back. Let's do our history here. We got to know where we've been to figure out where we're going. Dow finishes crashing here. We trade back up to 268 in the Dow, sell down, go up to 291. These happen to be the other two Fibonacci retracement levels that you'll see along the way, 38%, 50%, and that sets off a massive decline. Again, were people back in 1930 looking at retracement levels? I don't think so. They only really became used in the markets in the 60s, 70s, and 80s. So, you know, what's the chance that the Dow crashes down to the 618 retracement, trades up to the 38%, trades up to the 50%, and then goes off? Okay, there's something to this. It sounds like voodoo. It sounds like hocus pocus. I got it, but it works and it continues to work. So we're setting up trades around it. Back up from 1932, the Dow gets down to a low of 40.56. Imagine buying the Dow. Imagine buying the DIA at 40. It trades up to 195, and then let's go at it again. We had World War II, right down to 99. Actually, it was World War I. 99, which is the 61% retracement. We do a double bounce on it, double bottom, and then we're off to the races. So again, guys, is this, you know, does the technicals work in highly emotional markets? Yes. Are these self-fulfilling prophecies? To a degree, yes. But I also think to the other side of the equation, no. There is something to these levels. They are there are best representation of figuring out growth of interest in a market or decay in interest of a market. It does actually track how psychology is driving markets, which, make no mistake, psychology and people discounting future economic data or wherever they think the markets are going to be in the future is what drives price. It's not the data today. It's what's happening in the future. And people make those decisions based on less than all the facts, which is trading by the seat of the pants, which is fine. So that was World War II. I apologize. That was early 1914 to 18, as Larry says, and then World War II right there. Boy, I got to study from history. Now, truth be told, I'm going to tell you guys about a class I actually have coming up tonight, and I've been working all night. I got about 3 hours of sleep. I've been working hard on this presentation. So we have a course going off tonight that I'm going to tell you about, and I'm probably going to say some stupid things here today, so be sure to jump on me. Okay. I do know there was no war in 1987, but I do know there was a crash in 1987 that went down to the 38% retracement as well as the 50% price retracement. Okay, so again, if you look at these and you're like, Todd, it sounds like you're kind of cherry picking these levels. How do you know where to start and stop fib? Who's asking themselves that right now? Who's saying, Todd, you're kind of cherry picking this? I want to know who are my haters, who are my doubters. Okay, if you are, then good. I'm going to show you exactly where to start and stop fib and how to set up trades around it. All right. How about, does it only work in 1920s and in the 80 crash? How about the 2000 when Greenspan was slashing interest rates? That was going to set up the housing bubble. How about a move down to the 50% as well as a 6.8 retracement at the 2002 low? All right. So, you know, it's it does. They help to uncover patterns and structures that you wouldn't be able to see with the naked eye. Okay. So the analogy I use here is Fibonacci is to trading like who's been to Vegas, and you're looking at let's say you're staying at the Bellagio, and your wife is annoying you. You want to go shopping at the Wynn. She wants to go shopping, and you want to go play the Wynn's golf course, which we definitely want to do. So you're like, all right, fine. I look at the map, and you're like, all right, 1, 2, 3, 4, about 5 blocks. You know, I live about an hour away from New York City, 5 blocks. You could do that in like 15, 20 minutes. Do you know how long it takes to walk 5 blocks in Vegas? It would take like half a day, because not only Vegas is huge, but you got to go, you know, up the escalator, cross the bridge, get through those people handing out those stupid flyers there. It's going to take you half the day. So what you're missing there along planning your journey is the scale, or what we call the little key on the map. Right? You got to look at how long the actual trip is going to last so you can plan accordingly. That's what fib is. We all need a trading plan. Okay? The motto of my company is plan your trade, trade your plan. And I always think of myself as an analyst who just simply executes my analysis as a trade. Okay? And you're going to do your best trading that way. Okay? If you think like an analyst. All right, you should do 80% of a trade before dime one goes into the market. If you just sit down and just start taking signals on a chart, you're reacting to the market and you're going to get beat up. I'm just telling you that right now. All right, so that's fib. Myth busting number 2. John Murphy, who you guys all should know, he's really the grandfather of technical analysis. I consider him to be the best living technical analyst out there. I just think he's great. He was the technical analyst on CNBC from, even before it was CNBC, FNN in the 80s and 90s. And, of course, I've done technicals on CNBC since 2008. My career almost ended prematurely, but they kept me around. And he just does it wonderful justice talking about this idea of a self-fulfilling prophecy. And I'm just going to quote him, and you know, he's got it pretty well laid out here. The self-fulfilling prophecy is listed as a criticism of TA. It's more appropriate to label it as a compliment. After all, any forecast technique to become so popular that it begins to influence events would have to be pretty darn good, right? So, you know, I think it doesn't really answer the question, is it self-fulfilling? He's basically kind of tongue-in-cheek saying, well, if it's so damn good and it's influenced the outcome in the markets, it must be worth looking at. doesn't really answer the question, and my belief is it's a combination of self-fulfilling prophecy. People are looking at the levels, number one, and number two, there is something to this voodoo that we do. There is patterns. Markets are not random. It's not a random walk. There are repeatable patterns that we can look at and figure out where we are in a phase or a correction. Okay. Tell me what you're thinking, Michael. You don't like that analogy on what? Okay. Myth busting number 3. I only trade when my indicator issues a clear buy-sell signal. That's just science and math. Trading is more to that, guys and girls. Let's think about this. Trading is analyzing a circumstance, analyzing a market, and making the best educated guess you can with all the information that can be known while accepting the risk that is inevitable in an unknown event. The market's trading right now. What's going to happen 10, 15 minutes from now cannot be known. It hasn't happened yet. Nobody can predict the future. The best thing you can do is survey the psychology of the marketplace as well as your own psychology. Good trading is a combination of art, good pattern recognition. You've got to have good indicators based on sound math. And most importantly, most importantly, it is an understanding of the psychology of the participants driving your market, whatever you're trading. It can be S&P futures, it can be, I don't care if you're scalping intraday, I don't care if you're swing trading options, whatever you're trading. It's an understanding of the psychology of what people believe is going to happen in the future. And it's also an understanding and a mastery of your own psychology. Can you control yourself? Can you control your emotions? Can you follow a game plan? Even in the toughest of times when markets are extremely, really trying your patience or your P&L direction you want, can you trust your process? Okay, so trading is more than just following indicators, 10 times more than that. And that's what makes it so fun, is it is a great college career, science, math, and psychology. I have mothers come to me, fathers, you know, their son, daughter they want them to be a trader. What major should I put to? And I say, unless they're going to be a quant or, you know, some kind of geek running formulas, you know, to the social science, get them so they understand how mass psychology works. And if you understand how humans work on a space, that's going to make you a very good trader. Okay. So if you think when you first started trading, you know, I bet charts, you know, technical books, and you probably had, you know, a bunch of indicators all over your charts, and, you know, and MACD and stochastic back, and you're like, boy, my trading career didn't start out that well. And, you know, why didn't it start out well? Well, guys, if you're doing and using what is, how do you expect to make any money? And what I mean by that is, look at this. This is Dow trading with stochastics and MACD, two very common people at some point in their career. What is making these indicators move? Stochastics are more sensitive than MACD, but what is making them move? Price action. The only thing that makes indicators move is price action. So what you're telling me, guys, is you're taking trades in reaction to indicators, which are in reaction or reacting to change in price action. So price action moves, moving the indicators, and then you all of a sudden take a trade. Do you know that you're like third in line to get involved in the trade? And you really hope there's very smooth and good follow-through and continuation in the market by the time you get in and get the signal? Okay, I'm telling you, trading has got to be more than that. It's got to be anticipating price action. It's got to be getting ahead and say, I believe this is the area where I want to be involved in the market. It's trading with a plan. And I'm serious when I say my motto is plan your trade, trade your plan. I come in with a trade plan. I do videos for our clients, and I say, guys, here are 3 or 4 of the trades we're going to do in the next 3 to 4 hours. I'm a swing trader. I'll put trades on for a couple days, 2, 3, 4 days. You know, if they're winners, I'll have them for a week, 2, 3 weeks. I'll roll them up. We trade options. I mean, I did scalp futures today. I bought the S&Ps on the breakout today on the pullback. Bought the breakout. It's just a little scalp, but most of the trading what I do is planned trading, executing based on levels where I see the market's going. Okay? So from there, Let's just take a look at an example of a trade. This is ITV right here. This is an example of a winning trade. They're not all winners, but we were looking for support into that fib support zone. As soon as the market trades down in, we get a micro short-term confirmation you're involved at a premium price. Okay? McDonald's, another example, anticipating resistance in that zone. When and if the market respects, you're in at a very good level and the market moves in your favor. Does it happen like this all the time? No, it doesn't. But you know what's awesome is taking losers when your entry is excellent, is right here, because your stop loss, as I'm going to teach you, is just above the zone. The best way to become a better trader by next week is on the entry stop loss side of the equation. The hardest way to become a better trader is on the take profit side of the equation. What I mean by that is I can make you a better trader next week, guaranteed. Okay? Am I going to say that my system is 80% accurate? No. There's no. What system in the world is 80% accurate? Come on. You know, really? Come on. Guys, I have a system that's like 50%, and when I'm trading well, 52, 55%. But what we routinely do is risk X to make 2, 3X. Okay, and it's more like risking X to make 1.5X, 1.75X, and sometimes it's 2X. The best way to become a better trader is to be more patient, let the market come into your zone, get as close to you, your entry should be as close to the stop loss as you can. Do that time and time again, which decreases the size of your stop loss. If you do that in every trade, you watch the average size of your stop loss go down and down and down. You are, one, going to make more money than you are. Number two, you're going to eliminate those big losing trades that undo like 6 or 8 or 10 good trades worth of work. And we've all done them, right? You have 6 or 8 good trades, and then you get a little aggressive, you forget your plan, and you blow everything out. Okay? So, as I said, I can make you a better trader next week. I'm going to make you be more patient. I'm going to make you trade less, wait for the market to come to you. This is for swing traders, you know, guys who like to be in the trades down on the 5-minute charts for a couple hours, guys up on the 60, 120-minute charts for a couple days, guys up in the daily chart for a couple weeks. Okay? I can make you a better trader by giving you better entries, decreasing the size of your stop loss, by using methodologies that anticipate price action. Oh, it was 90%. Yeah, sorry. Listen, I don't know. Listen, guys, best hedge fund traders in the world. You know, I've met some of them. I've been to Paul Tudor Jones' party. He's the best guy out there. You know, those guys, you know, he said the best traders in the world aren't going to be right more than 40% over the lifetime, but they know how to risk X and just go for the throat when markets are really trading well. That's the reality, guys. I mean, literally, I keep track of all my trades. I have like when I'm trading well, I have like upwards of a 58, 59% win rate. And when I'm trading poor, I'm down around, you know, mid-40s. But the average size of my losing trade is bigger than the average size of my winning trade is bigger than the average size of my losing trade. And that's the game. So, all right, let's get moving here. There is pattern. There is structure to it all. It's not random, as Einstein says. So what we're doing is we're looking at an ebb and flow in the market. We're looking at a pattern, a structure, a growth formula, a decay formula. As market prices improve, as market prices deteriorate, it is not pattern, okay? Social progress, how we all do as a society, is not random. It is pattern. You can recognize patterns in social progress. And think about this, guys, what is our society's report card? You know, what reports up to the heavens how we're doing? It's our stock prices. It's how our stock prices are doing. The better we're doing as a society, not just in this nation, but nations across the world, the better our equity prices are doing, the better we're doing as a society. Societal interactions, how we all behave together, determines how our stock prices go. How we interact is not random. We have, you know, crazy events where people get all irrational and focused on one idea, follow madmen around, and markets reflect it. So there are patterns to it. It's not a random walk. I know it sounds like voodoo. Trust me, I even feel weird saying it to you. This is the only business I've ever done. I've been trading fibs since I was like 19, 20 years old. I'm 36. It's even weird to this day to say it, but this growth ratio that we're looking at here works. All right, so I'm not going to spend too much time on the math, but here's the granddaddy 618, and then a couple of ratios that I trade with a lot are derivations of 618, 786 and 1272, and as you can see over here, they're simply square roots. Again, you don't need to worry about the math, but we're going to set up trades today that play on the interaction between these two levels. But first, identifying swing waves. Guys, you need to first determine where to start and stop the fib, right? I mean, that's probably the most ambiguous thing out there about fib is where to start and stop. And I fully agree. Here's how you do it. You've got to understand swing waves, right? Swing waves are a low or high in a chart where price reverses trend. All it is for a swing wave high, the current high has a lower high before and a lower high after. So you got a high with a low bar left, low bar right. Simple. Swing wave low. You get a low bar with a high bar left, high bar right. Just a short-term change in trend. Okay? So here's an up-close look. You got a high with the bar to the left or just prior is a lower high, and the bar following is also a lower high. Very simple. Okay? There's Apple right there. Apple with the major swing waves. Right there, pretty simple. Swing wave low, same deal, low bar with a high bar left, higher low right. Here is the same swing wave right there. Okay, on the lows, actually this is the Apple chart, swing wave low, swing wave low, swing wave low. Okay, pretty simple. And then this right here is a chart with all of your swing waves labeled. So what do you do with this? We have to break it down into two types, major and minor. Okay, here's how we start building fib. A minor swing wave is a reversal. It's a swing wave. It's a reversal that is exceeded in the 5 bars prior and the 5 bars following. All right. After that, major swing wave is a significant reversal in the trend that is not exceeded in the 5 bars prior, 5 bars following. All right. So let's take a look at pictures. I'm much better with pictures. So we got a swing high, you got a low bar left, low bar right. And what you want to do is just basically count the 5 prior bars. 1, 2, 3, 4, 5. If none of their highs break above your swing wave high, you're good on the left side. You want to do the same thing on the right side. You want to go 1, 2, we're getting close, but we don't break above. 3, 4, 5, you're good. 5 bars left, 5 bars right, you're good. That is a major swing wave high. Now, I actually have an indicator where we do adjust and we play with these depending on the volatility of the market. We can go up to 8, we can go up to 13 to get some really big swings, but it really depends on what kind of trader you are. I'm not going to tell you that you should be trading, real frequent setups, on a 5-minute chart. Trading is such a unique endeavor, guys. I'm going to just give you the tools and the tools that I teach. I encourage all of my subscribers to make them their own. Some guys are day traders, some guys are swing traders, and you can adjust the tools to make them work for you. These concepts that I'm going to talk about are going to work in everything. Okay, so let's go to a minor swing wave. We have a high bar here with a lower one left, lower one right, so you got a swing wave. So you're going to count 5 waves to the left, you're good left, and then you start counting 5 to the right. 1, 2, and then we break above 3. So this remains a swing, but it's not a major, it's a minor. Okay? So there's that same Apple chart with all your major minors labeled, no problem. So now we understand swing waves. So from here, we have to understand the trend. And I think, those of you who are more advanced or more comfortable with the market and you're fine with identifying the trend, no problem. Here's just kind of maybe a shortcut. I think the 55 is the good moving average for trend indication. I think anything less than that's a little too sensitive. Anything greater than that is too slow. So what we want to do is only be trading in the direction of the moving average. We're not looking to buy pullbacks of the moving average. That's, as they say down here, that's horseshoes and hand grenades. We got to be more precise than that. This is just giving us a trend indication. So if the market, if you're seeing a 55 EMA up, you're looking at an uptrend. And the really look at the swing points. And if you're seeing the major swing points generally higher than the prior, then it's an uptrend. If you're seeing the major swing points lower, then it's a downtrend. Okay, so the three tools that we're going to look at, we're actually only going to focus on retracements, external retracements. There's about 3 other tools out there as well. There's about 6 that I look at, and we are going to be covering that later on tonight. But we're going to look at retracements and external retracements. All right. Now, let's just kind of step back and just revisit what trading is about, right? Let's just take a look at what retracements are, what we're trying to do. So, trading is nothing more, guys, than buying a pullback in the course of an uptrend. And trading is nothing more than selling strength in the course of a downtrend. And everything we're doing with Fib and all these advanced tools that we're looking at are designed to just get you in the market towards the later stages of the correction and as soon as we begin to move higher in the new trend. That's really all we're trying to do. So all the fancy stuff we're doing is really just trying to get you in at the correction just before the trend breaks out. All right, that's all trading is. I think 90% of the trades that I do are in this fashion. About 10% of what I do are actually counter trend trading. And you can fade the trends, but you need to have indicators and you need to have styles of analysis that are predictive, meaning you need to look ahead. And you're only going to trade against the trend with a very clearly defined plan and say, here's my levels where I want to move, and then a very clearly defined stop loss, and then the discipline to stick with it. All right? So this is a retracement, very simple. It looks a little bit more complicated, but it's really not. Let's say the stock starts at $200, goes up to $300, right? It's a $100 move. 55 EMAs up, that's fine. We're just simply looking to see what percent of the prior rally, which was $100, will be recaptured. So 38%, 50%, 61.8, and then there's another one down there at 786. So we're trying to figure out how far this move's going to go. Okay? So let's pull some of these together and let's start setting up trades. And this is going to help you kind of pull it together. Number one, isolate the trend. Apple 55 EMAs up. We got a good uptrend. You want to wait for the trend, the moving average, to kind of flatten out a little bit. You want the market to begin to acknowledge and just pull back, just take a little bit of a breather, which is fine, just like we did here. You want to first identify the most recent major swing high, which this nice gap up, and then they close the gap there in Apple. That's going to be your swing high. Then you want to find the most recent major swing wave low, right? So if you go back and use your 5-bar rule, you're going to see that that's the most recent major low. So in order to calculate Fib with longs, not like most tools out there, it doesn't matter what charting package you use, you're going to click the low point first, up to the high point. You're going to go from major swing wave low up to major swing wave high, and then the Fib retracements are going to unfold. So 236, 38%. There's half back, what we call 50%, 618, 786. Now, again, how do you know which one's going to work? Like, what do I do with this? How do you make money with this? Okay. So from here, you want to monitor the pullback, looking for swing waves against your retracement levels. These serve as your entries. Here's how we're going to set up the trades. I only will look to take pullback entries after we've got 3 swing waves. An initial swing wave low, you never buy the first correction. Okay, you never buy it. A vast majority of the times, that first correction against the trend is going to fail. Get all dressed up like we're going to break the new highs. Go down, stop everyone out, shake people out, go below the lows, and then only once the market has kind of rid itself of as many people as possible will the prior trend resume. So we're going to do a swing wave low, a swing wave high to a lower high, followed by a new swing wave low. Okay, so it's going to be what we call an A, B, C. And this 3-wave swing will ideally terminate between the 38% and the 61 retracement. And in certain circumstances, you will allow for the 786 retracement. All right, so let's just go to work on another one. This is crude. Crude on the 3-hour. Downtrend, 55 EMA, you got that. We've got to be sellers. And I'm going to look at charts after if we have time, and you know, I just really want you to look at that moving average before you ask me, should I buy crude oil here? No, the trend is down. Just make your life easier, please. Wait for the trend to exhaust itself and begin to pull back. Right? Okay. We're going to identify the most recent major swing wave low. That's the lowest and most recent swing wave low. It's got to be the lowest. Then you're going to find the most recent major swing wave high right there. And, you know, this is one. If you're looking at this swing, it is one. It actually, the trade would work with it, but I don't like that there was no moving average acknowledgement. It really just kind of traded right through it. Okay, so you're looking for a good major swing wave, and you're looking for one that gives the moving average a little bit of a break, a little bit of a pause. Okay, and plus this isn't a trend. I mean, that's too close to where you're looking to be short. You're looking to be short based on this downtrend. So there you go. There's your most recent major swing high, major swing low. Perfect. All right. And from here, use your retracement tool. For shorts, you want to click the top first, down to the low. All right. Monitor the pullback, looking for swing waves against your retracement levels. And remember, here's how you're going to set up the trades. Never trade the first reaction. You're looking for a push down for a higher low. Okay, it's higher low compared to this one. Then you're looking for the stop run. Yep, there's the stop run up. Now you've got a move to a new high. Now you're on guard for signals. And again, you want this to happen between the 38% and the 61 and up to the 786 retracement of the prior downtrend, which you know this is downtrend because your moving average is down. All right, so how do you trade? All right, it's all about entries. It's all about money management. It's all about keeping the money. Everything I've taught you here so far is very simple. It's the execution time and time again that makes you a trader. Okay, it's very easy to put on the winning trades, but in order to be very good at putting on losing trades and keeping those losers small, you have to have a plan, and that's how you become a better trader in a couple days. So here's the trade plan. Looks like a lot, but let me just use pictures because I'm a picture book kind of guy. I like to keep things simple. All right. So this is gold on a 4-hour. You've got to move up. I didn't include the moving average here, but gold is in an uptrend here. MA is heading up. You get a nice drop there, first reaction. You get a move up. This is a lower high followed by a next push to new low. Big old stop run. Nasty bar down there. Tried to collect as many shorts as possible before we stabilized. We are now on guard for longs. So here's that big bar that I just looked at. We're zoomed in. Here's how you're going to enter the market. You're going to identify the major swing wave low, okay, right there. Only after we move above, a couple ticks above that bar, you're going to buy stop in, okay? You're going to buy stop in once we move above that bar. Stop losses go a few ticks, pennies, pips, whatever you're looking below the low. You have very tight stops, okay? So you get your low, your lower high to your lower low. Here's your major swing low. You're entering above the high of that bar. Stop goes below, right there, and now you're off to the races. Now, if I get stopped out, all right, and we get another low bar with a move above, I'll take the setup again, provided we are above the 786 retracement. I'll take these setups twice. Provided you're above that final 786, you get a swing wave low, and then a move above, I'll take it again. All right? So that is entries. Okay? That's how you identify swings, that's how you draw your fib retracements, that's how you scan for setups. Now we know how to enter, play stops, and now we got to figure out how to take profits. So retracements, as we just looked at, are used to measure how far a swing will last before the predominant trend resumes. All I'm saying is a retracement is going to study this wave to figure out how far this wave will go before the trend continues. That's an RET, retracement. I'm drawing with my mouse here, so it's pretty bad. An extension is different.
Hey, Todd, don't mean to interrupt, but you are looking at about a minute left.
Okay. We'll drop down there and studying this move right here okay, looking for the next trend. So let me just jump ahead and show you how you're going to take profits on this guy. You are going to study the extension and then look to take profits on the 786 retracement. Pen, let me go right here, laser pointer, 786, and then up to the 1272. What you're doing is once you get past 100%, you're going to go up to the 1272. You're going to trail your stop. All right, we're going to cover the rest of it. Obviously, we got a little jammed up in time there, way off. I must have been talking too much. But let me just take you to the end here. We are going to do a class tonight. Let me just talk to you about this real quick. Anticipation is how you trade, not reacting. Okay, so if you guys are interested, we are going to do an advanced class tonight. Here's what it's going to entail. We've been working towards this one for a couple weeks. Tonight's the big date. We're going to go through all of this. We showed you about step 1 and 2 of my 10-step. Tonight's going to be about 3 hours, and we're going to do 4 live trading sessions after. So it's going to be a total of 5 sessions. So guys, if this made sense to you, if you want to get ahead, you want to stop chasing poor entries, being able to recognize the best setups now, this is what we're going to do. Taking quality setups. You got to stop chasing those poor losers, the losing trades. Trade the best stuff you can. It's not, as I said, going to give you 90% hit rate. You're not going to be trading from your yacht by March. I'm going to try to take you from a average trader to an advanced trader. Okay, so again, here's everything you learn. We are going to give a money-back guarantee tonight, and if you like, there's the website right there. I think we have 25 spots left. We are doing this at 8 o'clock tonight. Everything is recorded, archived. So just go to tradinganalysis.com/yes, and you can secure this thing for $97. All right, if you want to call in questions, there is the phone number. And again, we're going to start at 8 o'clock tonight. Everything's recorded. And then we're going to do live trading Wednesdays. There's the schedule, Wednesdays, all the way through March 18th down to April 8th. All right, so tradinganalysis.com/yes, and that will put you on the, I'll put you on the lineup for tonight. All right, guys, any questions? I'm going to do live analysis tonight. Reza says, I have another 10 minutes. True? Not true. No, I think I started at...
yeah, that was for the other presenter, I believe.
What's that?
The 10-minute message.
Oh, okay. Got it.
No, that was for the previous presenter. I put that in.
No, I just reason saying Todd's got another 10 minutes. That's fine. No problem. I'm at my 45-minute mark, guys. I appreciate it. But yeah, go ahead. I'm going to go back. We've got a lot to prep for tonight, and thanks to Reed and everyone. I appreciate you guys listening, and you know, you got the content. We skipped the sales pitch, but hopefully you see you guys tonight. And thanks so much for having me. I really appreciate the feedback, and Reed, I'll talk to you soon. Okay.
Hey, Todd, talk to you soon as well. I do appreciate you coming on today and spending some quality time with us, providing some quality content to the room. Ladies and gentlemen, that was Todd Gordon from TradeAnalysis.com. Yes.
Can I just mention one thing I forgot to ask? Somebody's saying, does it come in Meta? We have a free, I totally forgot. It's a terrible sales pitch. I got 2 hours of sleep. Got to take a nap. We have this indicator to come out with a major and minor swing ways. We have it built in TradeStation. We're having it built in all of the packages, and it is coming at no cost. So you do get the indicator for free. I completely forgot to mention that. So yeah, we have an indicator to identify major minor swings, and we're building the trade strategies around that. So yep, 97 all in, no recurring fee, and you're good to go. So thanks again, Reed.